Financial markets enable placement and consummation of what are called market orders, trade at the best price available, or limit orders, trade at a price that you set, at a price or better than the price you set. And the most important purpose of financial markets is to provide liquidity. Liquidity is the ability to trade quickly at a price that is close to the true underlying value of the financial asset. Of course, nobody knows the true underlying value, but you and I would have different estimates, and each of us put our money where our mouth is and trade on that basis. And the purpose of financial markets is to provide this liquidity without order flow distortions, which means no temporary demand-supply distortions. Now, orders essentially supply liquidity if they are open standing orders to offers to buy and sell. They are limit orders that are in what is called the limit order book, and that give other traders the opportunity to trade at the price offered. So when you want to trade, you will see a best buying price and a best selling price on the system. The people who offer them are supplying liquidity. While you go ahead and execute against those standing limit orders posted by the traders, you are paying the spread and you are demanding liquidity. So this liquidity is provided to the markets by what are people who are called dealers. Now, you and I can be dealers as well, and in financial markets like the National Stock Exchange of India, dealers are voluntary in the sense that there is nobody who is obliged to stand ready to buy and sell. It is typically just the totality of traders who would be ready to buy and sell, and their actions create the market. The liquidity suppliers, people who post these bids and offers, are critical to the functioning of markets. Now, financial intermediaries are of two kinds, dealers and brokers. Brokers are agents who just earn a commission for facilitating a trade. Dealers are the principals. They are the shopkeepers that buy with their monies when somebody wants to sell and sell when somebody wants to buy. And dealers are the ones who provide liquidity to markets. Now, dealer is a fancy word, but as I said, you and I can be dealers as well, or are dealers as well a lot of the time. I personally, when I trade, I'm supplying liquidity to the market and earning the spread rather than picking off quotes and paying the spread. So dealers are proprietary traders who post bid and ask quotes. They manage inventories, charge bid offer spreads to compensate themselves for their risks. After all, they are buying when you want to sell, and then they will sell when somebody else wants to buy. So they'll carry the inventory for that time and carry the risk for that time, and they therefore need to be compensated. And therefore, the bid price at which the dealer will buy from you will typically be smaller than the ask price at which the dealer will sell to you, like any car dealer in the market. Another important concept I wanted to bring across was, why do prices move? Am I hearing the disturbance, or is it's okay, it's gone. So why do prices move? And most fundamentally, prices move because of new information. New information changes expectations of future cash flows, the risk attributable to these cash flows, and the price at which the market discounts these cash flows. But prices can also move because of the absence of perfect liquidity. So if there's a large order, it can tend to move prices. So for example, if the best offer for Reliance is 1,000 rupees for 5,000 shares, and the next offer is 1,001 rupees for 7,000 shares, and I'm executing a 10,000 share order, then 5,000 shares will fill at 1,000, and the next 5,000 will fill at the next price in the book, which is 1,001, and the volume weighted average price for the order will be 1,000 rupees, 50 paise. And that is a liquidity related impact. So poor liquidity means higher bid offer spreads, poor quality of price formation, and therefore it's important that liquidity is good in the market. And the dealers, voluntary obligated, play a critical role there. Now let's talk about automation in securities trading and financial markets. Now, algorithmic trading has been on for on the NSE properly since 2008, and in other markets from before. And what algorithmic trading is the use of computer programs to read in market prices information and make order posting and trade execution decisions. So what is called high frequency trading which a lot of people may have heard. Is there any issue? Can anyone? Is everyone able to hear me?
Yes, Professor Pradeep, please go ahead.
Okay, thank you. Just wanted to make sure. So everyone may have heard about high-frequency trading, which uses computer programs to make very rapid trading decisions in order to compete for very small profits. And most of the time, high-frequency traders are supplying liquidity. So most of the time, high-frequency traders are there to do a very important job. They make money, but at the same time, they provide an important service to the market. 50 to 85% of trades today involve these robotic high-frequency traders. And if you are trading, the chances are that you are trading with a high-frequency trader rather than anyone else. Now, the automated versus human trading. So when you say high-frequency trading, the trading is obviously automated. There may be a human who will be controlling the big picture, but at the same time, the trades are executed automatically. And what does that really mean? So automated systems and algorithms that drive them have to be pre-programmed in advance, because clearly they have to work, they have to anticipate all kinds of scenarios, and they have to be pre-programmed to react to whatever scenarios you have fed in and take an appropriate decision which suits the high-frequency trader. So they have to be therefore programmed to operate under a wide swath of economic conditions and events, and they have been pre-programmed well before the events take place or can be reasonably anticipated. Now, in manual systems, you and I, economic agents, operate, decide, and react to events in real time, after or as the events are taking place. In automated trading, everything has to be pre-programmed in advance. How do we program for automated decision making in the future? Now, if you can, play a game of blackjack, the scene here is from that movie 21, and here the probabilities and models can be estimated. Everything is mathematically quantifiable. You know what is the best way to go forward probability-wise, and you can make your choices ex ante. It's not that difficult. It's quite easy. However, all decisions are not necessarily that easy, and decisions which a lot of people can regret for a long, long time after making them. In the world of financial markets, also you have the decisions which have to be taken, which are relatively complex. And the question arises, can we pre-program for traders and investors comprehensively for the future? Can we, for example, pre-program for automated future decision-making which comes from the brain of Rakesh Jindal or Warren Buffett? So that is the million-dollar question when it comes to, or in the case of high-frequency trading, $1 trillion question when it comes to high-frequency trading. I would raise a point here. I don't know, many of you may not know, but a gentleman called Donald Rumsfeld, he was managing the Iraq War at the time of George Bush Sr. And I find this quote from him very informative. It says, reports that say something hasn't happened are always interesting to me. Because as we know, there are known knowns. There are things we know. We also know that there are known unknowns. That is to say, we know there are some things we do not know. We know that there are a few things we don't know. But there are also unknown unknowns. The things we don't know, we don't know. And that is what economists call ambiguity, where we don't know what we don't know. Can automated financial systems and traders be expected to function effectively in the presence of significant economic ambiguity? And economic ambiguity is omnipresent. And this is economic conditions and events that cannot be reasonably anticipated, predicted, or modeled in advance with any reasonable precision. So let's fix this idea by thinking specifically about algorithmic trading. So Automated algorithmic traders should have a competitive advantage over human traders when it comes to data. They are not constrained by limits to human cognition, rationality in accessing and processing data across fragmented markets and rigid assets. They have an information advantage arising from the speed of data access and processing. And therefore, when it comes to processing data, they hold all the aces when it comes to human traders. However, as I emphasized before, data or hard news relations are not information. They have to be processed into usable information. And we live in a world of economic ambiguity. Processing data into information is, as I've said before, complex, imperfect, subjective, uncertain, and involves soft analysis. And therefore, as in the economic world, we say traders face preference uncertainty. And preference uncertainty is very, very difficult to model in a concrete fashion. So can automated traders be pre-programmed to address the entire spectrum of preference uncertainty in economic ambiguities? Now, the United Kingdom, the government of the United Kingdom commissioned commissioned 50 studies. They had what I call the Technology Foresight Program. And they commissioned 50 studies to look at various sides of the automated trading question. And one of those studies, Beyonce, undertook extensive interviews with traders and associated trading programmers in London and New York, and concluded that no, the world of high-frequency trading doesn't even attempt to pre-program to address the entire spectrum of preference uncertainty and economic ambiguities. No, it does not do that. The artificial intelligence embedded in economic algorithms is not too complex, simply because it is just not possible to have all decision-making possibilities duly considered and incorporated. These programs are just simple, and so that's one part. And so in good times, when things are working well, where the simple algorithms can work extremely well, algorithmic traders, remember, have the advantage of speed, have the advantage of information processing, and things go well. So extant research, including research by me, show that algorithmic traders, they lead manual traders, human traders, in price discovery and impounding information in normal periods. And in those periods, which are periods where you can model things, quite simply, they have the advantage, and the human traders can almost go out of business. They are the ones who extract the pound of flesh in the trading process. However, in periods of high ambient ambiguity, that is where we have the challenges to automated decision-making and execution based on these pre-programmed routines, and I dare say relatively simple pre-programmed routines with parameters which have been set before the event ex ante. If they are pre-programmed to drive at 40 miles per hour and they're suddenly required to drive off a cliff at 70 miles per hour, they may well end up falling off the cliff. And that's the scenario that we have to think about. Now, I have several papers on it, based on data from the National Stock Exchange of India, based on data from India. And one of these papers, which is based on evidence from India, finds that periods of high ambient ambiguity do actually pose particularly severe challenges to automated decision-making and execution based on these pre-programmed routines. During periods which have complexity, automated traders significantly reduce their participation by around 1/4 in periods of this high ambient ambiguity. And secondly, and more importantly from a strategic perspective, do algorithms lose their competitive advantage in information processing and speed advantages speed advantages during these periods of high ambiguity. Now, people can say, well, humans are likely to be best at reacting to freak situations and unexplained market shocks. And when the winds of change hit the markets, humans are still more adaptable, flexible, and able to change with the times. While algorithms can be reprogrammed, they can't be reprogrammed fast enough to take advantage of a contemporaneous shock. And human beings can react outside the box much more quickly. So algorithms, and what we find through our own research is, and through through two papers of mine, both of which use data from the National Stock Exchange of India, algorithms do actually lose the comparative information processing and speed advantages during periods of high ambiguity. Now, this has major consequences for intermediaries, for traders, for investors, for regulators, for exchanges, and for lawmakers. And let me talk very briefly about them. So, consequences for intermediaries first. Now, in today's automatic equity markets, so in the old world, when you used to think of the London Stock Exchange and you used to think of the New York Stock Exchange, you had dealers who were more monopolistic. London had comparative market makers, New York Stock Exchange had the specialist. And therefore, they were obliged to keep the market running all the time, and they were obliged to buy when somebody wanted to sell and sell when somebody wanted to buy. Today's markets are what I call order matching markets, where you and I can participate just as well as any dealer. And liquidity in today's order matching equity markets is created through standing buy and sell limit orders, which are posted entirely voluntarily by traders with no formal affirmative obligations to maintain liquid and orderly markets. And as I said before, algorithmic traders supply well in excess of 50% of this liquidity. Now, as far as exchanges and the regulators are concerned, they would like to ensure consistent and continual availability of liquidity. That is, consistent and continual availability of standing limit orders to execute against for both buy orders and sell orders, and both in good times and in bad times. So, relative to human traders, automated algorithmic traders strongly reduce their participation in liquidity provision during periods that display abnormally high and persistent volatility and abnormally high and persistent order imbalances. That is, in periods of significantly heightened economic ambiguity. As has been shown by two papers of mine. One is based on the markets in India, the equity markets in India, and the other is based on the US futures markets, trading in commodities in the US futures market. Now, this change in trading behavior corresponds one-to-one with the change in information advantage of different algorithmic traders. And that's important to keep in mind and appreciate. So all categories of automated traders also withdraw from the order book significantly more than their manual peers during abnormal stressful periods. Not only do they post prices which are less likely to execute, and therefore you see fewer trades in which automated traders are involved, they also start posting fewer orders which are available for execution by other people. And with the exception of exchange members, all automated traders also place orders that are less aggressive than the orders of corresponding group of manual traders. And we also find that the reduction in automated trades as to manual is not only because automated traders withdraw from the order book, but also because they charge, if they stay, they charge a higher price for liquidity services relative to manual traders. For the cost of liquidity goes up, you pay more for your trades. What are the consequences for traders? First, automated trading, the first consequence is horizon. So long horizons erode the automated trader competitive advantage of trading in and out. So automated traders want to use the advantage of speed and automation and want to get in and get out quickly. The average horizon can be a few seconds. So they tend to be short horizon traders given limited capital. They're position risk only when they expect to profitably offload their positions within their ultra short trading horizon. And therefore, the question arises, does automated trading lead to short-termism? And the short answer to that question is yes. Then algorithms are pre-programmed in advance. All of us tend to have similar education. We go to business schools which teach from the same books. We go to other schools which teach us the same kind of programming skills. And given that the predictability in financial markets is very limited anyway, algorithms tend to be very similar in design. And therefore, the result is high correlation in trading by different automated traders. And so algorithmic traders are less diverse, more correlated than those of non-algorithmic traders. How can you correlate the trading of Rakesh Jhunjhunwala and Warren Buffett with the traders of trading of you and me? And because of this, it leads to short-term volatility. Everyone is in the same direction for short periods of time, and that correlated trading causes a burst in short-term volatility. So, for example, one of the studies in the Technology Foresight program in the United Kingdom showed that a driver for the future risk and catastrophes lies in the fact that the seemingly large biodiversity of traders is actually illusory. And in a stress situation, algorithms quickly and unwittingly coordinate, act in unison, and feed each other in a feedback loop, thereby leading to disproportionate value destruction. And the keyword is quickly and unwittingly. So it's unwitting. They don't want to do it, but that's what ultimately happens. What are the consequences to investors? So once again, this is another study from the Technology Foresight program. They argue that the propensity for deviations of fundamental value are greater in markets dominated by algorithmic trading, since, and I love this quote, algorithms know the price of everything and the value of nothing. They have data, but do they have information? Market dynamics dominated by very short horizon robots runs the risk of being freer in the sense of being more decoupled from a fundamental anchor, such as the fundamental valuation of payoffs and earnings. And in an article in the Vanderbilt Law Review, it's argued that algorithmic trading therefore weakens the ability of prices to function as a window into allocative efficiency. This is because informed traders, which are long regarded as fulfilling gaps in information, have fewer incentive to participate in the algorithmic markets and to correct these informational deficits. Why? Because if you're an informed trader, you would invest in information in order to profit from it. But with the advent of algorithmic trading, because algorithmic traders are able to lead the rest of the market, in trying to implement trades which enable you to profit from information, you would tend to surrender a fair amount of the rent that you were hoping to get to algorithmic traders. So these large deviations from prices from fundamental value and slow reversion back to it represents a potentially high transaction cost for investors. What are the consequences for markets, regulators, and lawmakers? So both for equity markets in the US and for equity markets in India and for commodity markets in the US, we have research which shows that in normal times, algorithmic trading leads to better price discovery and greater pricing efficiency and lower transaction costs and greater liquidity. All of us know how expensive it was to trade 20 years ago and how cheap it is to trade today. A lot of that has come about because of algorithmic trading and automation. And that's a pervasive and positive consequence of automation and electronification. Having said that, would like to give a quote from Andrew Haldane, a gentleman I respect enormously, not an academic. He was executive director of the Financial Stability at the time when he gave the quote at the Bank of England. High frequency trading, HFTs, high frequency trading, liquidity, evident in sharply lower peacetime bid-ask spreads, may be illusory. In wartime, it disappears. This disappearing act and the resulting liquidity void is widely believed to have amplified the price discontinuity is evident during the flash crash. HFT, high frequency trading liquidity, proved fickle under stress as the flood turned to a drought. So this is an issue. The bottom line conclusion from the UK Foresight report was, algos improve overall liquidity, but it also generates the greater dangers of episodic illiquidity. A very important conclusion. And the chairman of the SEC at that time said, given their volume and access, high-frequency trading firms have a tremendous capacity to affect the stability and integrity of the equity markets. Currently, however, they are subject to very little in the way of obligations, either to protect their stability in tough times or to refrain from exacerbating price volatility. This quote is also in 2010, and let me assure you, nothing has changed in 11 years. Things are very, very similar. Now, the regulatory concerns about the stability of algorithmic liquidity supply are omnipresent and are reflected also in proposals in multiple jurisdictions aimed at constraining algorithms. There are limitations on the number of cancelled orders, because algorithms can, go in and cancel orders just before they can get executed. You have the famous case of Sarao, the gentleman of Indian origin trading from his his parents' apartment in Hounslow in London, who was alleged to have brought about the flash crash, which I completely disagree with, but nevertheless. Regulators have require codes to have a minimum life before they can be cancelled or revised. And in two of my papers, I show that there is very good reason to be concerned about withdrawal of algorithmic traders from liquidity provision under stress. Now, we have in two other papers, both based on Indian markets, we have a few conclusions. We have a few other conclusions which relate to trading in stress. First, when algorithmic traders withdraw from liquidity provision, that tends to further exacerbate the manifestations of stress. So persistent volatility and order imbalances lead to more volatility and order imbalances. There's a cascade effect. So this generates fragility, market fragility. Second, given the significantly higher correlated trading among automated traders, the stress passes on also to related stocks. And we show that in the context of India very strongly. That is contagion. So you have contagion and you have cascade fragility. And their market fragility risks for intermediaries also increase significantly, because of intermediaries also increase significantly. And another paper, focused attention on the not so level playing field for information in the era of algorithmic trading with co-location. Now, co-location is where certain market participants have their servers right next to the exchange server. And co-located direct trading firms are able to receive information, release, automatically trade that information, change the price, all before non-co-located traders with only the normal feed can even see the information. And this is sanctioned in the United States by the SEC and hence legal. The question is it fair? And finally, as we wind down this presentation, we have consequences of exchanges. This bad stuff can hit the fan. And talk about bad stuff hitting the fan. Knight Capital, a long-standing securities firm with impeccable reputation, large influence, evaporated in 30 minutes due to a programming glitch. Which brings me to the issue of liability, which is the eroding effectiveness of long-established liability standards, which are negligence, strict liability, and intent-based fraud. And in an age of automation, these need to be redefined. Compensation conventions may be ineffective where small errors can result in very large costs owing to interconnections in the algorithmic markets. So to conclude, automation represents the inevitable march of technology and brings enormous benefits to our society, and more specifically to our focus of investors, intermediaries, and markets. However, every change throws up new issues and that need to be thought through and highlighted so that they can be eventually addressed. And every major change opens up enormous avenues for research as well. And of course, this is a research symposium. I close with a quote which our first Prime Minister Jawaharlal Nehru used to love to give, a quote from Robert Frost. The woods are lovely, dark and deep, but I have promises to keep, and miles to go before I sleep, and miles to go before I sleep.
This is the outline. So basically, I will take these three topics in order. First, I'll talk about the impact of managerial tone on capital markets. Then after that, I will talk about use of textual analysis of documents to infer information content. And then I'll talk about the use of machine learning algorithms to make decisions and the impact of machine learning on firm disclosures. All right, so let's take them one by one. All right, managerial tone. So let's talk about managerial tone. There's a lot of research on managerial tone over the last 8 to 10 years. With the availability of computing power, ability to sort of process it using powerful computers. So this research has exploded over the last 7 to 8 years. So what is managerial tone? It primarily refers to linguistic tone used by managers in their interaction with analysts and investors. Okay. So what tone they are using, either orally or in terms of the text, in terms of the words that they are using, what is the tone? So either in terms of the written content or the oral content, what is the tone of the content? So linguistic tone is the extent to which a body of text, oral or written, contains positive or negative words. So primarily the focus is on positive or negative words. Is the tone positive? Is the tone negative? How does that impact how the market reacts to that, the analysts, investors, and so on. So the most studies in this area have examined the quarterly or the annual earnings conference calls held by companies. Many of you may be familiar with conference calls. So this is all publicly traded companies have these conference calls every quarter, along with their earnings announcement and all the other things, release of the annual report, 10K, 10Qs, and so on. So they have the conference calls. And primarily the people who dial into the conference calls are analysts, financial analysts are the primary people, and a few, and a few institutional investors also. They also dial in. It's sort of difficult for the ordinary investor to dial in because they sort of screen, are very careful who they let into the conference calls. So either you have to be an analyst or an institutional investor to dial into these conference calls. So these are a major channel of communication between companies and their stakeholders. Okay. So this is big. Okay, this is very important. It's a big deal. CEOs, CFOs spend a lot of time preparing, carefully thinking about what they're going to say, what they're not going to say, how they're going to say it, and so on. It's a lot of time spent by the top management of the company preparing for these conference calls. Usually the format of these conference calls is there's a formal presentation, a PowerPoint slide, dog and pony show. Sort of, there is no interaction during that time. So they go through all the numbers, what they think, what the future of the firm, what their strategy, how they did over the past year, the past quarter. And then there is an interactive question and answer session. So that's how generally how these conference calls work. So the early studies in this area focused on the average tone in a conference call. So they would look at the whole text or the whole transcript of the call. They had the software, which sort of analyzes the text. Some artificial intelligence software, machine learning software. These software have become better and better over time. First, initially they were very crude, and then over time they became better and better. They focus on the average tone, so they read the number of positive words in the text, the number of negative words, and say, okay, on average this was negative, or on average this was positive, or a part of a conference call. Okay, this part was positive, this part was on average negative, and so on. And what they find is that the linguistic tone of a disclosure has incremental effect on the capital market over and above the quantitative information in a disclosure. So disclosures have all the quantitative information. Okay, this is what our earnings were, this is our revenues, this is our earnings, this is our earnings per share. This is our, the ratio, this is our cost. This is our inventory, this is our cash flow, all that quantitative accounting information, which as an accountant, of course, obviously I'm, focused on a lot of these things. So that, of course, drives the market. We know that, and all the earnings, revenues, cash flow, all these things, of course, drive the market. But they found that over and above that, the linguistic tone, so how that disclosure is made, whether it's made in a positive tone or a negative tone, also affects how the market reacts to that disclosure. So more specifically, if the managers have a positive tone in their disclosure, analysts and investors react more positively to the disclosure. Okay, so that can be reinforced. Okay, so if a positive tone, so you can drive the market. Similarly, if the managers have a negative tone, the analysts and investors react more negatively to the disclosure. Okay, so the tone does make a difference in terms of how the investors, how the market, and the investors in the market react to the disclosure. The reaction is asymmetrical and is quicker and stronger to positive tone than to negative tone. Okay, but over the long run, the negative tone is a better predictor of the long run financial performance of the firm. Okay, so positive tone basically only has a short-term kind of effect, stronger short-term effect, quicker, stronger short-term effect. But the negative tone basically tells you more about what's going to happen to the firm over the long run. Okay, so this is really interesting. So there's a lot of papers on this. We're talking about at least a dozen papers, sort of one sort of refining over the previous paper, using better software, using better methodology, and so on. And so this is sort of the as of today. This is sort of I'm sort of summarizing in these three bullet points, sort of what we know in terms of this research, how the average tone in a disclosure, the linguistic tone in a disclosure, positive or negative, affects the analysts and the investors. All right, then we come to more recent research, which is doing like finer methodology, getting into more detail. So provide two examples of more recent paper, which is one of my colleagues here had that. Okay, now what happened here? Okay, something happened. I'm not sure. Are you still seeing my screen? Shobhit?
Yeah, I can see the screen. It is still at the managerial tone.
Yeah, but
Continue.
I cannot see my slides anymore. Haha. Let's see.
You may want to stop sharing and then come back again, Siva.
Yeah. See, somebody was admitted and that sort of okay, all right. Okay. All right, now I'm able to see my slides. All right. Shobhit?
Yes, sir, it is visible. It is at the managerial tone slide.
Continue. Okay, all right. So, um, so one line of research examines what tone dispersion. Okay, so the degree to which tone words are spread evenly within a disclosure. Okay? So they're saying, okay, all right, instead of like, you know, the positive or negative being spread out or happening like, you know, you know, together in one place, if we spread it out evenly, you know, what happens that time? So they find that the tone dispersion has an incremental effect on analysts and investors over and above the average tone. So it's not only the average tone that matters, but if that the tone is dispersed evenly, okay, over the disclosure, that also has an incremental effect. Okay, so now you can see this becomes more interesting, and the research is becoming more refined, and the people are doing the research are getting into more and more detail. So it's not only the average tone now, but also how the tone is dispersed over the disclosure. Okay, and the quantitative information. So incremental effect over the average tone and the quantitative information in a disclosure. So in other words, if positive and negative words in a disclosure are more evenly spread out, they have more of an effect. Okay, so that is basically what we're talking about here. If you spread out the positive and negative words evenly, more evenly spread out, they have more of an effect, or incremental effect. All right, another line of research and has focused on the within disclosure variation in the tone. Okay, so this is a working paper that I got to review recently for a journal. You know, obviously, I mean, I don't think I know the identity of the authors, and anyway, I could not disclose that even if I did. So in other words, does it make a difference if the conference call ends on a high note? Okay. So they look at the conference call and say, okay, all right, they find that a lot of these conference calls, the managers end on a high note. The high note means what? A very positive note. Okay. So they say, okay, this research is primarily focused on the interactive question and answer Q&A session of the conference call, because you know the other session is what the managers make a presentation that is not, you know, it's basically a PowerPoint slide and so on. So the interactive session is the more interesting one, which follows the formal presentation. Okay. Results show that managers end on a high note to mask negative information. Okay, so it's very interesting. So when they have negative information, when you know things are not going well for the particular quarter, you know, the managers, what they do, they end on a high note, say some positive things, or you know, and things like that, to mask the negative information. To hopefully, you know, people think so. So basically, what this is based on the psychology research, that people remember what the most recent thing that you said. Okay, so the managers are trying to sort of, you know, do some psychological manipulation of the investors and the analysts. He said, okay, if I end on a high note, you know, maybe the analysts and investors will remember that, you know, the positive thing, and they will forget all the negative stuff. But it doesn't work that way. So what the research has found, that the analysts and investors see through this deception, and it results in negative stock price performance and downward analyst forecast revisions. Okay, so you cannot, you know, although the managers try to manipulate the analysts and investors, try the psychological manipulation, but it doesn't work on average. Okay, and because the analysts and investors see through this deception, and it results in negative stock price performance and downward analyst forecast revisions when they do this. So that's what the research has found. So now, so the research becomes what? More and more interesting. They get into the more and more detail, you know, and the results become more and more interesting, and we know a lot more about the managerial tone and so on. How it, you know, the details, you know, if you spread out the good news, the bad news over the disclosure versus if you end on a high note, what happens, and so on. All right, let's go to the second topic of my talk, which is what the textual analysis. So textual analysis primarily focuses on analyst research reports and company annual reports. So basically what the text, okay, you're talking about the text, you analyze the text. So you have a software, read the text, okay, and you program the software to look for certain things in the text. I put in keywords, look for keywords, things like that. And so Is text, so we first let's talk about analyst research reports. Is text in the analyst research report incrementally useful over and above the quantitative information in the report? Many of you might have read analyst research reports. I have read thousands of them for my research. Typically they have earnings forecast, revenue forecast, price forecast, target price, buy, sell, hold, investment recommendations. So these are sort of the the quantitative information that they have, and and then they have a lot of text. So the analyst has a lot of text, discusses the performance of the firm, what they think, their opinion, what they think of the firm, what they think of the management. So examples of textual information: the product quality, management effectiveness, the competitive, how competitive the industry is, and so on. A lot of textual information in an analyst report. Sometimes there are pages and pages of that textual information. So the researchers, have examined, is all this textual information, is it useful to the capital market, to the investors? So the results show that the market reacts incrementally to the textual opinions in annual analyst reports. Okay, incrementally over what? The quantitative information. Investors attach twice the weight to negative opinion relative to positive opinion. This is really interesting. Okay, so whatever the textual information, they have negative opinions in the textual information. The investors attach twice the weight to negative opinion relative to the positive opinion. Investors react to analyst opinion more intensely when it places greater emphasis on non-financial topics. Okay, so things like the risk faced by the firm, competitiveness, um, product quality, management effectiveness, corporate governance kind of issues, regulation, so all, sort of non-financial means what? Non sort of, accounting numbers kind of topics, more like sort of the soft topics, and so on, is written more assertively or concisely. So instead of rambling, it's written in a more assertive manner, in a more concise manner. It has more, the market reacts more. And when the report contains bold or conflicting quantitative summary signals. Okay, so if they make some bold statements in the thing, or anything that is in conflict to the quantitative, some of the quantitative information that is out there, like for example, this quarter the firm did really well, but the analyst feels that next quarter they're not going to do very well because of certain reasons, and they show why the firm is not going to do well over the next quarter or the next year, or the long run outlook does not look well for the firm, or there's something coming up, like there's some regulation, or something, or the competition is going to become more intense, and so on. So something that conflicts with the current performance of the firm, or the firm is doing badly now but the future looks much better, and so on. So they react more to that. All right, then what? The company annual reports. So how about the company annual report? The text, a lot of textual information in the company annual reports. Of course, the annual reports have all the financial statements, obviously, but there's a lot of textual information. Of course, the most popular is what? The MD&A, the management discussion analysis, which is a lot of text. Okay, so one of the things they have looked at is how readable is the text. So they had used what is known as the fog index, which is very popular. Okay, so how readable is the text? So research finds that firms with poor readability of the annual reports have lower current and future performance and earnings persistence. So there's a correlation. Firms that do not perform well, current performance, future performance is not good. They also do not do well in writing the annual reports. Poor readability. I guess they don't have the money to hire a writer. Okay, just kidding. So or the management cannot write well. Not only they cannot manage well, they cannot even write well. Okay, so the poor readability of annual reports. Poor readability of annual reports has a negative effect on investors and analysts. Okay, So the investors, what the stock price goes down, the analyst, revise the earnings forecast downwards if the annual report is not readable very well. Also, there might also be poor readability of annual reports. The investors and analysts might also suspect that, okay, they're trying to hide something by being vague and rambling and things like that. So that is also another interpretation of the result. So the managers, by making the annual report not very readable and being very vague and rambling, the managers are trying to hide negative performance. Okay, so that's also another interpretation of this result. Textual attributes are associated with regulation in different countries and incentives for transparent disclosure. Okay, so how readable or what the attributes are, the regulation, what the regulation is, and different, countries have different regulation. So depending upon the regulation, the textual attributes are different. The readability is different, and incentives for transparent disclosure. What is so if if there's a company where the incentive for transparent disclosure is more, the readability is much better, and so on. IFRS, many of you, people who are like, the audience, is familiar with accounting. The IFRS, of course, is the International Accounting Standard. IFRS adoption resulted in increased disclosure and reduction in boilerplate disclosure. So there's a lot of these boilerplate disclosures, but IFRS adoption resulted in reduction in the boilerplate disclosures, and also resulted in increased disclosure and increased readability also. All right, let's go to the third topic. And here I think, maybe there's a little bit of overlap between here and Professor Ramachandran, who's going to follow me in a few minutes, because he's going to be talking about artificial intelligence and all those kinds of things. So machine learning, artificial intelligence, they're all sort of, sort of on the same topic, very highly, correlated with each other. So with the availability of computing power on a desktop, we don't need these mainframe computers anymore. We can have a powerful desktop computers. So there's increasing use of computer programs to process firm disclosures. So one of the things that has been looked at, and this is again one of my colleagues here at Georgia State, if a firm's disclosures are more amenable to computerized information processing and machine algorithms, which is known as what the term that they use for that is what scriptability. Okay, so this is a new term that the authors of this paper invented. Scriptability. Firms' disclosure are more amenable to computerized information processing and machine algorithms. That means what? A computer can process that information much more easily. So you can write a software to process the firm's disclosures, or you can write an algorithm, artificial intelligence algorithm to process the firm's disclosures. Does it have an impact on analysts and investors? So they did this study, and it was published in a top journal, and the results show that the speed of the market response to filings increases with scriptability of the firm's disclosures. Okay, so the more the firm's disclosures are amenable to computerized processing, if we can have a computer process the information, the disclosures, and or you can have an algorithm, machine algorithm process the disclosures, the speed of the market response is higher, which makes sense. Okay, so because the machine, probably it's also what you program the machine to trade also. So not only to read the information, process the information, but also have a trading algorithm for that based on the information. So they all work together, and so a lot of automation there. So this is all that is happening in the market. This is what is happening. People, investors, analysts, people are, institutional investors are programming machines to process disclosures, firm disclosures, as soon as it's filed. So as soon as the thing is filed with the SEC here, so the machine processes the information and puts out some kind of a trading, the market, some kind of either buy or sell or whatever, and so the speed of the market response goes up a lot if the firm's disclosures are more amenable to computerized processing of the information. The research shows that So this is a game played by the companies. So the management appears to know this. Okay, so the management of the companies appears to know this, that a lot of traders out there, a lot of institutional investors, analysts are using machines, computer algorithms to process the disclosures that they're filing. So now they're playing games with this thing. So the companies adjust the way they talk, knowing that machines are listening. So this is really fascinating. Okay, so now the machines are sort of processing the information disclosures, and managers are adjusting the way they format the disclosures so that it's favorable the machine looks at it favorably. Okay, so results show that if a firm's disclosures have more machine downloads, it motivates firms to prepare filings that are more friendly to machine parsing and processing. So the managers are aware how these algorithms work. Okay, because the managers, the firms have resources to hire these people too. So they know, okay, how these algorithms work. And so they say, okay, all right, now I'm going to play games with this thing. I'm going to manipulate the information so that the machine views my disclosures more in a more friendly manner. Okay, so that's what do. Firms with high expected machine downloads manage textual sentiment and audio emotion. Okay, so not only text now, we're also talking about the audio. Okay, because a lot of these algorithms, the machines, they also process audio. Okay, so manage textual sentiment and audio emotion. Okay, so audio during like conference calls and so on, and things like that, in ways catered to machine and artificial intelligence readers by avoiding words that are perceived as negative by computational algorithms. Okay, so so it looks like they know what these algorithms do, and then they sort of try to manage their all the text and the audio to sort of manage that so that to avoid words that are perceived as negative by these algorithms. They exhibit speech emotion favored by machine learning software processors. Okay, so they even the speech emotion, how they how they speak, what tone they speak, the words that they use in the speech, and also the tone that they use, how loudly, whether they speak in a soft way or a loud way, speak slowly, speak fast, and so on, and how they phrase things, so that the machine learning algorithm will process it in a positive way. So it's a lot of very fascinating things, starting with what the managerial tone in the conference calls, the textual analysis of the annual reports, the analyst reports, the machine learning algorithms that are used to process disclosures, and the managers responding to that and trying to manipulate how the algorithm sort of views the disclosure and so on.
So today I will be talking about a bunch of topics, again, statistics and projections as to how this whole market is evolving over the past 5 years and what analysts are projecting over the next 5 to 10 years time. So I'll talk about some of the industry research that has been done on this area. And then I'll talk about AI, because AI is such a broad context, and people need to get hands around what is AI in some sense and how it is applied in the financial and accounting segment. So I'll try to provide some context and structure around that, and then we'll touch a few on the few solutions that are available, and then what I think is going to be the future over the next 10 years' time. Again, this is partially my own reading and projections, but especially as it relates to the banking and accounting arena. Yeah. So what I'm going to do is I'm going to stop the. Give me a second. I'm going to stop the share for a second, and I will. I wanted to rival in some ways to what Professor Yadav had shown, but in a different way. Let me see whether it works. It's nowhere near what Charlie Chaplin's video showed, but this is something that you may want to look at in terms of how AI is now becoming even more pervasive in our own setup. Okay? So.
Hi, I am Mitra. Welcome to HDFC Bank. How may I help you?
How do I apply for an education loan?
HDFC provides education loan without any hassle. I can help you meet our relationship manager Amir who can provide further details.
Before that, I would like to go to the cash counter.
Sure, let me take you there.
So as you can see, this is kind of a cheesy take on how banking and financial institutions in India have been adopting. Again, this is not new. This has been around for the last 3 years or so. And banks around the world have been using these kind of virtual assistants or robotic mechanical assistants to get some brownie points from the customers. And a robot in and of itself has got a lot of different types of AI that goes into it. And obviously I'm not going to educate on that process, but clearly there is a vision there. There is a aspects of mechanical movements and the engineering and design aspects around that, and the ability to do all the necessary speech to text and text to speech. The ability to process natural language processing capabilities are embedded, right? But in a sense, it is a very rudimentary way of how AI has been applied, or in a banking situation. You could have just had people have started putting iPads and other tablets, and then being able to provide that information. So it is just another extension of that. So there's not a whole lot of ingenuity in this whole exercise, right? But people are trying to use much broader ways of engaging with customers. So I just wanted to provide that as a starting point to say how things are changing in India. And obviously, things are much more advanced in other parts of the world, right? So with that, again, what Charlie Chaplin was showing there about probably close to 70, 80 years back, probably a lot more advanced in terms of the ability to have machines provide food in an automated way, right? So that, again, in restaurant business all over the world, especially in Japan, there is tremendous use of robots there, and that's, again, is permeating to other parts of the industry as well. All right. Let me go back. Oops. Okay, I hope you guys can see my screen. And so we were here. So let me start by talking about some of the projections that have been made. Again, these are all projections as it relates to how AI is going to be, how much of interest is there both in the venture capital firms and the investment community, but also by corporations to use AI techniques on their day-to-day life, right? So expected $50 billion by 2020. I think that actually is a lie, because because of COVID situation, the use of AI and AI-related applications actually surpassed significantly above the $50 billion mark. And so again, these were projections at some point in time in the past, and then obviously it turned out to be not so true. Likewise, they expected to reach around $110 billion in the next, that means almost more than double in the next 3 years' time, which is highly likely, I believe. And so there are projections from different areas, whether it is from IDC group, again, an analyst group that has done the necessary survey, or by Forbes magazine or others who have been talking about the productivity gains that financial services firms are likely to achieve, and to a tune of $140 billion, which is fairly significant. And there is a tremendous amount of positive. Obviously, these industry analysts and vendors in the space are going to provide a very positive outlook. Just like we talked about the fact that why would CFOs or CEOs provide a negative outlook in terms of forecast? They're obviously trying to hype up the market, and but there is some element of truth to what they have to say, and there is clearly there is some smoke there, and that means there is some fire somewhere in the embers, right? So from that perspective, there is they're expecting that the AI in the fintech sector especially reach about $8 billion in 2020. Again, out of this whole $50 billion, $8 billion are focused on financial services, and the remaining are mostly in the retail sector. That's where AI is predominantly used, and then manufacturing as well. And then it is likely to grow to about $27 billion and growing at a CAGR of 23%, which is fairly significant growth just in the financial services sector. Gartner projects that the value created, again, the way they do the composition of value is from productivity, efficiency to risk avoidance to a bunch of other things. They anticipate that it'll be close to $4 trillion in value savings for corporations, what AI is going to provide them. Right? The India's economy is expected to gain about $250 billion through its GDP by end of 2020. I don't know whether that has hit the mark. I wasn't sure about that. And then this is again by Google had done the survey, and then it's going to double in the next 3 years' time. And they also expect that about $500 billion will be added to the Indian economy in the next X number of years. So there's a lot of ways. This is by one of the senior vice presidents of Google India who had talked about this in the recent past. So the fact that there is a lot of positive views in terms of how AI is going to help and add value to the Indian economy as well as from a global financial services sector bodes well. I think that's why people and faculty members especially needs to be aware of what is going on in the space from a practice standpoint, because as MBA students and others are going to be looking at financial services, which is going to be a lucrative market in terms of how to position themselves. It is going to be an important aspect to look at in terms of actual data points. So say these are the projections. World Bank has done very similar studies in terms of how the use of AI and fintech and related technologies, like blockchain and IoT, is going to help. And so they all are kind of trending and projecting to the similar type of data points. So the other aspect I wanted to touch on is in terms of, I do rely a lot on what the industry analyst firm Gartner and Forrester and others provide, just as a rule of thumb to say, okay, what are they thinking about and how are they projecting, right? I don't know whether you guys can see this or not. So this is Gartner uses something called a hype cycle. If you're not familiar with that, it goes through any technology goes through 5 different phases, starting from the innovation trigger, somebody's thought process, somebody's head, and then it goes through the process of productivity, right? And in 2017, as it relates to the hype cycle, Gartner had projected a number of different aspects of AI from from human in the loop crowdsourcing to general artificial general intelligence to speech recognition on the other side. And they said that how long it's going to take for it to reach its plateau of productivity, and then going through the different phases. And they had talked about predictive analytics and virtual analytics and speech and cognitive computing, all this in this space here, very crowded space. And then if I just compare that to 2019, for comparison purpose, because it likes to have a good understanding of the trend of how these different technologies are evolving over a period of time, how these are being adopted as well. You'll find that obviously speech recognitions and some of the GPU accelerators, which is on your mobile phones, those have obviously become a lot more mature now. And then chatbots have reached the peak of inflated expectations in 2019. Use of chatbots and other technologies as well. So now, if you look back in last in the 2020 cycle, when they released it in July-August timeframe, you'll find that speech recognition is no longer even in the chart because they feel that it has become mature and it's an accepted thing. So whether you're using Alexa, Siri, or other types of mechanisms, speech recognition has matured enough for them to not even start counting it, right? Things around machine learning and other types of chat bots and computer vision, they expect that to evolve over the next 2 to 5 years time. But there are 5 new entrants in the 2020 cycle that they are thinking that they should be focusing on, and these are related to small data, generative AI, composite AI, and things as customers. So these are new terminologies that have been added on, and I'm sure that the industry, the finance and financial services industry and others are going to latch on to these very fast. And so basically what they're trying to do is, instead of just looking at big data, which was the talk of town 5-10 years back, you are able to find much more powerful data sets that you can make decisions on, right? Whether it is the textual information or non-textual information or unstructured data, doesn't matter. But those small sets of data that can actually drive you to make decisions, and especially when it combine that with IoT devices and the edge AI, it becomes even more relevant. How do you create that real power-packed rich content, right? And so there is a lot of work going on in the area of small data. In terms of generative AI, is it all those things that they are going to basically focus on how you can use existing data sets and existing samples and algorithms and create something totally new, right? Whether it is in terms of being able to do depth predictions or fake, deep fakes and things of that nature is where a lot of, and then creating the fraudulent transactions and how do you massage that. Professor Nathan talked about how these disclosure statements, that they understand machine learning is going to read those texts, and so they write the text in such a way. It is very similar to people who are in the HR profession. Nowadays, most of the resumes are read by machines, and so the writing the correct keywords become important. So similar to that, these generative AIs are the ones that are going to start capitalizing and learning from those words and similarities and creating appropriate in pieces of information, new pieces of information. Composite AI, again, is a combination of different types of AI that come together, etc. So, and then the things as customers is important because now what is happening is it is no longer just when you look at the customer as a human being, they may no longer be that. It could be a combination of IoT devices that could be acting as a customer as well. So when you are providing customer service, you need to be recognizing that there could be machines at the other end of the line where you need to provide appropriate service. Gartner is predicting that by 2025 or so, 40% of customer service organizations are going to be become profit centers. They are no longer going to be the cost centers. So they need to de facto become leaders in the digital customer engagement. So people who are in the marketing space, financial services depend a lot on marketing and digital marketing. They are going to be thinking about things as customers in a much more meaningful fashion. So they're going to bring in customer strategy, organization, technology into the mix as they are developing their plans. And let me just make sure that I'm on target here. I know I have to speak a little fast. So AI, I had to want us to look at it from multiple different angles in terms of how one considers or views and analyzes artificial intelligence, especially in the space of banking and financial services. And so the first thing I would call is technology and technology clusters, whether it is in terms of different types of ML techniques or deep learning techniques, vision and natural language processing, textual and text to speech, speech to text, optimization techniques, etc. So you need to understand from that standpoint. From a technology cluster standpoint, there are things like chatbots, which has been very heavily touted in especially in the last few years. Last year during COVID-19, probably chatbots got the biggest boost, if you will, in terms of people using AI-based chatbots. And so there is those clusters. The chatbot is one cluster. The cognitive process automation is another cluster. InsurTech, RegTech, those are all different clusters that come together as technologies to help out. So you need to think about what solutions are being formed within those specific areas. So that could be one of the dimensions. The other dimension is you just look at the industry itself. The industry, again, BFSI is not one monolithic industry. Obviously, you have the wealth and asset management industry. You got the brokerage and trading industry. You got your mortgage and mortgage financing industry, whether it's a primary market or the secondary markets. You got your basic retail and commercial banking. You got the insurance. You've got your digital payments, which is becoming more and more prevalent in India. So crowdfunding is another aspect of the industry. So again, so you have to look at these subsectors and see what kind of AI solutions needs to be put in place and how these different technologies come to act together, right? Then obviously you have the functional areas. When you look at finance and accounting, there are probably about 17 to 18 different functional areas, starting with your financial planning analysis, to accounting, taxation, procure to pay, operational accounting, governance and controls, and so on and so forth, right? The performance and your basic general ledger, back-end operational procedures. You need to look at all these different functional areas and say what kind of AI solutions can be put in place. And there is a plethora of different solutions focused on different functional areas as well. And then the final thing that I would say is in terms of the application focus itself. So we just heard from algorithmic trading, how AI is helping out in terms of your basic trading and settlement type of approaches. We know that NSC, for example, they're probably about 50% of their trading, or 50 to 60% of the trading is in algorithmic trading. So no human beings are involved. There's no longer going down to the New York Stock Exchange and they don't have runners and callers and so on and so forth. And 80% of their trading is done in an algorithmic fashion. And the DTCC, which is their main trading and settlement agency in the US, they have started becoming a lot more automated. They're no longer T+3 type of trading that's happening now. It's they're getting into a place where they can think of near real-time settlement, which has not reached there yet. But the ability to reconcile and manage those settlement process, that's going to drive DTCC and other agencies like that to be able to get to the point where they can, not just get to a T+1, but the whole straight-through processing that was happening, it's becoming a reality now, basically through AI techniques. Again, credit decisioning is another application focus area. Personalized banking, you heard of robo-advisors in the Robin Hoods of the world, how they have been in the news recently, and how these are actually, even in India, the robo-advisors are now becoming more and more popular, especially with the educated, quote-unquote, educated class of investors, right? So you can look at AI in different dimensions in terms of purely from a technology perspective, in terms of type of technology that you're using, or in terms of the different verticals, or in terms of the functional areas that it is supporting, and or the application focus. Typically, you will find that you need to look at it in its entirety. And then IDC had done a recent study in terms of how these focus has been on the market share of the AI, and from automated customer service management to IT automation to threat intelligence, and we'll talk about that in a second, and fraud analysis, and being able to manage the sales recommendations and portfolios. So those are the typical ways how AI has been used till 2020, but that's probably going to change quite a bit. Okay. I'm going to speak a little fast now because I see the clock running out on me. So I just wanted to check in terms of time, do we have a few more minutes, or how are we doing? Shobhit?
Yes, sir, you can take.
Okay. So I'll just provide some illustrative solution areas in multiple ways. And again, this is just illustrative. So the first one is the credit decisioning and fraud detection, basically to help in making smart underwriting decisions, to be able to target the right communities, be it in terms of people who are students, who have not been traditionally, have not had banking. So if you look at the whole Grameen Bank that started a while back, and nowadays, with the prevalence of digital payments in India, where you wanted to reach out to the 450 million people who are sitting in the villages, how do you access them, and how do you provide credit to the farmers and other small traders who may not have the banking transactions and credit history? How do you provide those? And that's where some of the, a lot of new tools and new vendors have come into play, whether it is in terms of people like Zest Finance and who are auto lenders using machine learning to provide underwriting capabilities. And to be able to do that, they have, the companies like Data Robot, which provides, financial institutions quickly to build out, predictive models based on how whether there have been credit card transactions, fraud or not, and then being able to provide additional, capabilities to the customers. There is a Sonipat systems that I've, been involved with a little bit, and they have helped out financial, again, institutions in predictive models, and so on and so forth. So they have actually been working with some of the larger companies, banks in the Wall Street area, providing actual dollar value savings from a loss prevention standpoint. The other big area that we don't talk about a lot is in terms of cybersecurity and cyber risk management. And you every day you hear about at least 5 new cases of where whether it's Air India's data being stolen and being used for different nefarious activities, or for what we just heard with the entire colonial pipeline being hacked, and they're taking away $4.4 million in ransomware, and so on and so forth. So I think there is probably every day, and even today, I think Microsoft came back and said that the problem that they had faced 3-4 months back, that has not gone away, right? The fact that they are still being hacked. And so how do you prevent those? And where artificial intelligence has not had an impact, much impact, is in terms of prevention. Where it has focused more on is in terms of detection and identification. So whether it is in terms of, if you think about by 2021, there's going to be $6 trillion losses at least globally due to cyber risk threats. $360 billion in banks alone, right? So it's a fairly significant sum of money, probably equivalent to GDPs of many nations. So how do you do from threat detection to network security to mobile endpoint connections and data centers, managing the ironclad data centers that we may have, vulnerability management. So they are doing a lot of things related to, especially bank and financial services that I've been working with, have doing a lot of work as it relates to social engineering aspects of it and understanding the behavior of how these black hatters work and and how do they prevent them using other countermeasures, right? And how do they do all the necessary DNS data exfiltrations and zero-day exploits and all those things that they are using based on the data sets that have been collected, right? So I was working with the bank in Middle East a while back, and they were able to track as to where there may be spurious entry points that may be happening. Because if you typically look at how these networks have been operating and where these different pings are coming from, and if they suddenly find a ping coming from Nigeria where there was no previous transaction, they're able to find that click, right? And saying that, okay, why am I getting from this particular DNS server or this particular IP, why am I getting this ping, right? So, and again, this was about 4 or 5 years back, and so obviously that has advanced. So there is those kind of levels of detection and prevention are happening, but it needs to get more robust. But as hackers have become even more sophisticated, so there is a lot of work that is being done in the AI space as it relates to cyber risk management in the financial services world. We heard a lot about the quantitative trading, especially in terms of algorithmic trading. So there are a number of different aspects of quantitative trading, from trading patterns to identifying arbitrage. Talked about the bid-ask spreads that you may be there, which may be very short-lived for a short period of time. How do you take advantage of that? And that's where these things come into play. And there are several companies that have been powering out, based on these AI stuff. So, companies like Alpha Sands, and they have been working with a lot of the Fortune 500 companies. They provide a platform that uses the natural language and then analyzes the keyword searches with filings and so transcripts and everything and discovers, based on RSS feeds and research and news items that may be coming out, identify changes and trends that may be happening in the financial markets based on that. Then there are, Covout is another, vendor that has been offering some scoring mechanism to say, they, flow through a whole massive amounts of data sets and then condenses so that the top management can look at it and provide it in a more visual way and say, okay, these are the ranking for stocks for today, right? And so that before the trading day begins, they can look at these things and use that and combine it with the algorithmic trading to start saying, okay, here is what I want to push for today, right? So, so there are different technologies and companies that have been working on these things fairly aggressively over the last 3-4 years time frame. The next one is obviously personalized banking. We are all familiar with the robo advisors and the chatbots, and whether it is in terms of identifying those opportunities for increasing the financial literacy of individuals or segments of society. These have been very, very useful. The example that I shared before in terms of the HDFC or ICICI banks that have been promoting these robots, mechanical robots. It is, though very cheesy, they have tried to burnish their image in some ways, the brand images, to show that they are totally in the in the latest and greatest of technology. SBI and HDFC and ICICI over the last 3-4 years, they have all developed the chatbots, and now chatbots are the new in things, especially in Indian banks. And again, these are not completely automated. They are not conversational chatbots, but they have created at least appropriate mechanism to do text mining, appropriate mechanisms to be able to do the natural language processing. So they have definitely done work on that front. Still a long way to go. So I think there is, people, if you think about banks, TD Ameribank and Bank of America, they are reasonably advanced in terms of what they have done with use of chatbots and providing both mobile apps as well as real-time support and spending insights. So they have been actually gone beyond that, right? And then there are other companies like AI, that's a virtual financial assistant. So what it does is it bridges the gap between like Google Home or your SMS feed, Facebook feeds, Amazon Alexa, and it kind of combine those things to provide a much better user experience to provide convenient banking facilities, right? So there is so these kind of chatbots have obviously advanced quite a bit in the last 3 to 4 years' time. In terms of accounting and audit and taxation, if you talk to any accountant or auditor, one of the things that they will keep talking about is that we are in finance and we are drowning in data. We don't know what to do with it. While at the same time we are starving for information, right? So while you have a lot of these data that is coming in, but how do they process that and how do they synthesize it to a point where they can actually make sense out of it? So the aspect of gathering and storing and doing further analysis, especially because they have to deal with a lot of paper, right? They're uploading those documents, understanding the entries and classifying them. So the whole aspect within ML around classification, segmentation, and that aspects has been very well understood. And so it has been adopted, AI has been adopted in many other firms. So if you think about an auditing process, having worked in many of the big four companies for a number of years, these auditors, they probably have about 400 to 500 tasks, right? And so whether it is the review, the audit review procedures that they have to look at the audit evidence, or classification, whether they are, like, for example, if they say it's a collectible debt or a bad debt, they have to look at the materiality assessments of any kind of transaction. So they can apply fuzzy logic for continuous assessments of information. And then any kind of going concern decisions that they have to make. If they find that the company is not probably going to have some bad outcomes, then they have to figure out as to what kind of decisions to make. This whole uncertainty and the ambiguity decision making that was mentioned before, how do they use some of the ML techniques to determine that, right? And so as part of the audit functions, they incorporate these things. And so this whole question of previously they used to do, if I remember about 10 years back or so, 10 or maybe even 7-8 years back, sample data, sampling data was, audit was done. It was never on full data. So I think in the future, it's going to be 100% audit on all your transactions, irrespective of what happens, right? Because even large corporations, it's going to go through that. I remember in the turn of the century, companies like WorldCom and others, when they kind of went kaput, Arthur Andersen went kaput, and that's because they were just doing some activities that are either partially systemic problems and some others not, right? So the whole aspect of invisible accounting is going to come into play, where AI is going to take over many of the accounting and auditing functions to be able to do that. And our KPMG has been using some of these techniques, so as Deloitte, PwC, I mean EY, former alumni, especially in UK, they have been using drones to do assessments of of real estate, so that when they do the audit and contractual obligations, especially in the transaction advisory services standpoint, they can actually do all these things in a very meaningful fashion, right? So they can bring the lease agreements and then the contracts, and then along with the photos, and then they can do an assessment and say whether it's okay or not okay. So the different many of the big four companies have been using that. Of course, there are challenges when it comes to taxes, especially on a cross-border basis. Tax codes are complex in one country. If you look at the U.S. tax codes, it just runs into millions of pages. So again, when you start thinking about a cross-border type of tax regulations, especially between EU and UK now with the Brexit and US and other parts of the world, it just gets really complex. So I feel that there is going to be a tremendous amount of use of AI, especially with the scripting that was mentioned before, or the model creation and algorithms. That's going to help resolve some of that. But the underlying tax code logic needs to be somewhat simplified, and hopefully something like that will come to fruition. And then the final thing that that I will talk about is in terms of the digital transformation or automation. Now this has become the buzzword for many institutions. Many of the large banks that are doing, the simplest example would be the robotic process automation, RPA techniques, that has helped large organizations, financial services, banks, and others, to simplify and automate all the manual tasks that is happening in the back end. When companies like JP Morgan Chase and Citi and others, when they were renewing their contract for BPO services with all the Indian IT firms, they typically do a 7-year deal or a 5-year deal, which runs into billions of dollars. They basically said that, hey, listen, we want you to provide the same level of services, but cut it down. Your value is no longer going to be $1 billion. It's going to be $600 million or $700 million, because they felt that a lot of the manual things that are being done in the back end could easily be automated using RPA tools like Blue Prism or UiPath or others, automation anywhere that could be helping through the process. And so now it has become quote unquote fairly common for people to understand. So I was with one of the reinsurance companies of Berkshire Hathaway called Gen Re, and we helped automate their tax process, right? In terms of the folks were spending every quarter, they were spending like 10-15 days just trying to get the data downloaded from their different pieces of software, reconciling them, eliminating rows and columns and spreadsheets in 26 tabs, and and then uploading it back into their tax software. It just burning people out. And so when we implemented the an RPA, they basically cut it down to three days, and with much less strain on the analysts. And so that's one example. Bank of New York Mellon and Bank of Montreal, they went through a similar exercise. When they were planning to transition to more automation. AIG insurance company. When we went through decomposed their entire process of the insurance processing, they said out of the 3,500 sub-processes could easily be automated. Xerox Corporation, when we were talking to the COO, she was saying that out of the 50,000 employees that they had, after automation, they were able to bring it down to 35,000 people, right? So that's a tremendous amount of cost reduction, productivity, and efficiency that they can bring into their corporation. So whether it is in terms of basic RPA or cognitive process automation, which is kind of extended beyond the regular manual transformation, to embedding more of decision making into the workflow and logic, I think that's where the future is going to be, especially in the BFSI sector. All right, so let me try to wrap things up here. I know I'm probably about 10 minutes too much, so let me try to wrap it up what I feel. I believe that in the next 2-3 years' time, there is going to be a lot of intelligent chatbots that is going to make this conversational AI into the mix, bringing more of the workflow components and business process management and workflow into the whole aspect of robotic process automation. All the audits are going to be automated. You're not likely to have auditing companies trying to go through the books. It's going to be a lot more streamlined. The AI is going to help in terms of cybercrime prevention. The spike that we see in terms of cybersecurity threats and cyber terrorism, that's going to kind of put at a cap. So that's the AI is going to help through that exercise. And then there is going to be a lot of persona-based banking. What that means is that you're going to create, individual personas to say, here is how I need to target at, college graduate, how I need to target at, a persona of a person who is a vegetable and a fruit seller versus somebody who is doing, small trading. So they're going to, banks are going to come up with these unique products and services, and so are insurance companies. They're going to provide different types of insurance capabilities. That's already started. In 2003, when I was at IBM, we had talked about at that point in time pay-as-you-go insurance premiums for companies. It started in Europe, and then it's slowly now in the US, where most insurance companies now, they have black box in your cars, and then they are able to determine as to how you drive, how you position your mirror. They are able to track every moment, and one of the projects that I was doing was with AAA of NorthCal, so they were basically we were collecting the data on this is again telemetry and telematics that comes into play, and on the front end side, where we are collecting data of every 6 seconds the vehicle was moving, how you're braking, how your steering wheel is, how your position, how your hands are on the steering wheel. Every item was being captured, and we are storing it in a cloud based in Phoenix, Arizona, and then a lot of AI techniques on top of that, right? In terms of trying to figure out as to what does that mean and how do you translate that into insurance premium, right? So those things are going to get a lot more sophisticated. And now most insurance companies in the US at least have started doing that. So as in Europe, right? So it is definitely coming, I feel, in the next 3 years' time. Financial literacy and inclusion is going to become even more important, and those are going to be driven by AI. Probably there is going to be some level of human intervention, but it is going to be driven by AI. If I look further beyond, there is going to be conversational banking, this whole Personetics. If you look up at the company called Personetics, they have essentially tried to reimagine how the entire customer lifecycle flow is going to happen, and they have tried to create these exercise in terms of the value chain across the customer and how they interact with financial services firms. Right? Automated trial balance and monthly soft close, they're trying to reduce that process and make it more easier. Cross-border payments, there are a lot of different companies that are working on this cross-border payments in a much more elegant manner, and especially with the use of blockchain. There is going to be more focus on intangible assets. It's not just going to be tangible assets, so it's going to be things that you may hold as an organization that is not just going to be based on your real estate and buildings. And so balance sheet is going to be modified, and so immediately if you look at the Ind AS or your other IFRS accounting schemes, those are going to be obviously going through some shuffle as well. Just like what happened after the 2008 mortgage crisis, when they implemented FIN 46 and other schemes to bring about the changes in the accounting standards. Similarly, that's what is going to happen. And this one is going to be driven by technology. There is going to be a lot more emphasis on platform-based plug-and-play models. That means that there's not going to be, I buy this particular from this vendor and they buy this from vendor. They're going to come up with a completely new architecture for financial services firms. and that's going to be somewhat disruptive as well. Okay, and then finally, if I look back in way into the future, I think Capgemini had come up with a study, I think yesterday or day before yesterday, and then they talked about 2030. What is fintech going to be doing? But I'm extending it beyond, and I'm thinking about mass personalization and micro consumption. So you, as an individual, will want certain financial products and services that may not be there for anyone. So it is a segment of one, right? So that is been the retail goal for a number of years. I think it may come into play in the next 10 years' time. Digital identities will be ubiquitous. Now you see that. If you think about it, you've got your wearables, you know who you are when you wake up in the morning. It'll say, okay, your glycemic index is X or your sugar level is Y. And based on that, that information is going to your insurance company, your health insurance company, and they're going to change your, going to send you recommendations in terms of what medication to take or what your premium is going to be for that month. So, I mean, things are going to be pretty wild out there, I think. And again, there is going to be more of openness in terms of how different organizations interact with each other through APIs. And that is a huge piece of work that is happening behind the scenes. And that's going to enable easier data sets and technologies to talk to each other. And that's going to enable more AI and machine learning techniques to be applied. So you're not necessarily going to have a IBM Watson that is going to control everything, right? Typically, banks have been, monolith in terms of the vertically they are all fully integrated. They own the customer, they own the products, they own the technology. But I think going forward, those things are probably going to change. Customers are going to look for outcomes to their whatever the particular financial institutions may be, but also technology companies, whether they are the Googles or the Amazons or some reincarnation of that, they are probably going to be as much a player in this financial services space as any banking institution that we know of right now. SBI and others, State Bank of India, which or the Punjab National Banks, with all its nationalistic duties, I think there is going to be clearly competition to them, whether through the post office, which already has a whole bunch of network, and they can easily offer these services, or through the whole aspect of the digital banking capabilities you need for your branches is going to break down, and or the post offices are going to act as their consolidators, if you will. So there is a tremendous amount of change that is going to happen. There are about 10,500 fintechs in the world today. There were 4,400 about 10 years back. And so what is going to happen in the ads, each of them are going to focus on different, undeserved or underserved, area. The large banks are going to feel the heat from these smaller fintech companies. And so all financial services firms will be fintechs, and they'll all be using AI. So it is going to be the future. That's how it's going to be. So there won't be banks in the way we thought, thinking about them right now. It is going to change. Urbanization is going to change. Whether it is in terms of maglevs or you're thinking about your hyperloops and other forms of transportation. That's going to change the way people live in the cities, and that again will change the way we work and how we operate and behave. And so it is no longer when you're looking at mortgage, it's in the housing prices, the current crazy market all over, especially in the U.S. Or the other side of the equation in India. The mortgage pricing and the mortgage servicing aspect will also evolve and change. So there is going to be changes in multiple ways, whether it's from the regulatory standpoint, using RegTech and InsurTech capabilities or through other mechanism, you are going to find that life is changing, and a lot of that is going to be driven by AI. And whether those are the robots and the humanoids that you may be thinking about, I strongly believe that there is going to be ultimately better capital allocation that's going to happen at individual level. There is going to be better income equality based on the fact that there is democratization of data, democratization of use of AI that's going to drive, make people more happy.